To start with, I'd like to just kind of give you a working definition of high-frequency trading, especially since there's been some misinformation, I think, in the last several days. So the definition I work from is that it is a form of algorithmic trading where firms use high-speed market data and analytics to look for short-term supply and demand trading opportunities that often are the product of predictable behavioral or mechanical characteristics of financial markets. I think it's important to illustrate that high-frequency trading is a form of algorithmic trading, whereas the algorithmic trading category is much broader. What is high-frequency trading's role in informationally efficient markets? Well, Eugene Fama describes an efficient market as one in which prices always fully reflect available information. And data used to move a lot more slowly. So if we think about in the 50s and 60s, when finance was emerging essentially as a field of study, you know, the image I have is we have men arriving at work, and they were always men, in fedoras, right, going to a conference table where they were smoking Lucky Strikes and sitting around and poring over quarterly and annual reports. They were putting up on the wall, they were putting up paper where they could hand draw charts about market trends and stock trends and all of that stuff. Well, high-frequency trading is really a contemporary application of the same process that takes advantage of the increasing speed and quality of data that we now have available to us. So high-frequency trading peaked in about 2009 at 61% of New York Stock Exchange volume, but it's been steadily declining and has been expected to be approximately 48.5% of that same market in 2014. Profits have also been declining. In 2009, profits from high-frequency trading were about $7.2 billion, but they were down to about $1.8 billion in 2012. So in a sense, the market is handling the proliferation of high-frequency trading. High-frequency trading is not taking over the market. But the speed overall of high-frequency and algorithmic trading has increased as time has gone on. But this desire to beat the market is not new. But in efficient markets, informational inequities that allow you to do so are very short-lived. And so the motivation for high-frequency trading is to process information more quickly than competitors and find opportunities to make a profit. And so how has it benefited the market? Well, it's improved liquidity through reducing spreads. It's also reduced transaction costs from 7.6 cents in 2000 to 3.8 cents by the second quarter of 2012. There's been greater overall market speed and efficient price discovery, actually reduced impacts of volatility, and of course, the increased availability of direct market access for a broader number of traders. So some concerns have been raised recently. And so the question we want to consider today is, are these concerns consistent with a market failure that needs to be addressed through some form of aggressive regulatory intervention? And I'm going to discuss four here, the four that I discussed in the paper. And those are the risk of moving to a two-tiered market system, flash crashes, volatility in general, and of course, noise and market integrity. So let's explore the two-tiered market system first. So the big concern is that large brokers utilizing high-frequency trading will be operating on one tier while everybody else will be, due to informational asymmetries, will be working in another tier, okay? That's not necessarily a new issue. In 1921, F.W. Taussig observed that financial markets seem to diverge from the ordinary reasoning of supply and demand as they are subject to information that is not widely known, because it is just not possible for everyone to get the exact same information at exactly the same time. That has always been the case. And professional investors have always had more time, resources, and information than personal investors. In fact, mutual funds were created to try to fill that informational gap that because professional investors generally outperformed private investors. And so while there's still no way for everyone to get information at exactly the same time, there have been a lot of improvements in informational gaps. First of all, market data is available to most people on their computers within 10 seconds, and sponsored access and co-location provides high-speed market access to a much greater number of professional investors. However, for most of us, the strategy remains the same. What do? We buy mutual funds and we hold them for the long term, right? That hasn't changed for most of us. So, second issue, the issue of volatility. This is also not a new market phenomenon, okay? So in 1927, Frederick C. Mills observed that market volatility in the form of overreactions and overcorrections was existing, okay? Traders have traditionally have a tendency to react strongly to the most recent information and ignore long-term trends. So if there's new information, especially if it's unexpected information, there tends to be a rather significant reaction. However, a review of 150 years of worldwide financial data found that stock market volatility is highest during episodes of economic and political turbulence and exacerbated during periods of war. So while some have suggested that the volatility that we experienced in US markets in October of 2008 through about September of 2011 was due to high-frequency traders becoming more prevalent in the market, that volatility was more likely the result of economic turmoil from the subprime mortgage crisis, and then, of course, the resulting insolvency of many large financial institutions. So now, markets are a little bit different in the sense that we have some other factors that can kind of exacerbate volatility at times. For example, we have this increase in individual investors who are investing themselves through 401ks and other vehicles for their retirement plans. And these investors tend to rely very heavily on macroeconomic information, things like rising unemployment rates, falling home prices, budget deficits, sovereign debt, concerns about national debt, all of these things that they're hearing repeatedly broadcast to them on the news every night. And a lot of that information is more likely to be sentiment information, meaning it's information that causes fear or optimism. And so these individuals tend to be either all in or all out of markets. They don't adjust portfolios for risk. They tend to be all in or all out. And this was evident in the first 7 months of 2010 when investors withdrew approximately $33.12 billion from mutual funds. So while this is an additional factor, the primary causes of volatility have not necessarily changed in 150 years. So high frequency trading is not causing that issue. The flash crashes is a third issue. So we know that on May 6th of 2010, the Dow Jones Industrial Average fell more than 600 points, or about 6%, in a matter of minutes. High-frequency trading has regularly been blamed for this event by the media, politicians, and even academicians, even though a joint report by the SEC and the CFTC explicitly states that high-frequency trading was not to blame. Instead, what had happened was a firm tried to sell 75,000 E-mini contracts for S&P stock futures that were worth about $4.1 billion in 20 minutes during an already stressed market. Previously, that same firm, when they would try to sell that number of securities, would have done so over approximately 5 hours. And so what happened was, while high-frequency traders initially began absorbing some of the initial sell pressure, they did what every other individual participating in the market did at that time. They pulled back as soon as the asset started to go toxic, which is what any investor would do. So the 2010 flash crash was not caused by high-frequency trading, nor were the flash crashes of 1962 or 1987, okay? So to say that high-frequency trading causes flash crashes is just not accurate based on the evidence that we see. The fourth and final issue. is the issue of noise and market integrity. So market noise exists when competing and or contradicting information exists, or when the amount of information becomes too great for the market to process. Again, noise is not new. Taussig observed it in 1921, and Fama found that market participants anticipate information and adjust prices based on this noise before it becomes known to the general public, indicating many of the buy and sell decisions in financial markets over time have been based on expectations and not current information, unless, again, that information is unexpected. And if it is unexpected, then it tends to result in an overreaction or an overcorrection situation. So increases in the velocity of information over time coming from the internet, social media, computerized trading platforms for amateur investors, the 24-hour availability of news, the global economy, and 401k investment decisions in the hands of average citizens have all created additional noise in contemporary markets. High-frequency trading can actually help with market noise because computer algorithms can process a much greater volume of information and much more quickly than individuals can.